Welcome to Money Matters TV. My name is Paul Mitchell. I'm a vice president with First Cornerstone Bank. I'm your co-host today. And joining me is another co-host, Richard Sichel with Philadelphia Trust Company.
Hi, nice
Richard,
to be here, Paul.
Good to see you again.
Nice to be here.
So, as the Chief Investment Officer of Philadelphia Trust, you must be delighted with stock market performance. You must be just rolling in dough, as they say.
I try to take credit on up days, but yeah, we're long-term investors, and you have to go with the flow. And what we constantly tell people is there will be up days, there will be down days, and that stocks are the best long-term investment. And I sometimes scare people when I say, and they can be the worst short-term investment. I could buy you the best stock in the world, what we think is the best stock at $40 a share. It might close the day at 38. It doesn't mean it's bad. It might mean that something happened in Ukraine or who knows where.
Yeah.
And we might want to buy more of that stock. If it's a good company, we stay with it. And you have to ride the bumps in the market and over the long term, be a patient investor and a quality investor, and you'll make money.
What's your take on some of these alternative investments, whether it's commercial real estate or gold or private equity markets, things like that?
Yeah, we really invest in U.S.-based companies, about 2/3 large cap, 1/3 mid cap, which is similar to how the Standard & Poor's index is, and high-quality bonds. So I wouldn't call it plain vanilla, but it's very easy to understand and not very esoteric at all. There may be times where there are other asset classes that are doing better, but we think that if you stay with these high-quality asset classes over a period of time, you'll do better than most other investors and with less than market risk or market volatility.
How about like technology? Some of these smaller companies that are on other certain stock markets that may not meet your normal criteria, I guess.
Yeah, so mid-cap companies, we will go with them, and that's like $3 to $10 billion market capitalization. So they're not exactly small, fledgling companies. The smallest of the companies we do not invest in. And that kept us away 15 years ago from the dot-coms.
Sure.
They were tempting, but they did not meet our criteria for having earnings and a track record. So we watch, we want earnings, and we'll pay up to a certain amount for those earnings. So we may miss some of the $2 stocks, but we don't want to be in them.
Sure. I saw a recent reference to some of the highs of the NASDAQ, and it said that whatever it was 12 or 14 years ago, that the NASDAQ was trading at 120 times, I think, previous year's earnings. And now it's around, 20 or something like that?
It was very extreme. And again, we were glad we stayed away from them. And we had, Microsoft and big companies like that, and they went down too, but they stayed in business and they came back. So yeah, the NASDAQ might be around that number again. However, there's earnings, and there's no really sort of panic to get in. And as they used to say, the taxi driver doesn't tell you how much money he made today in a stock that you never heard of, you the professional. That's when you get a little wary. So, the good companies with good earnings, great cash flow, and technology is one of the places that we want to have an overweighting in those investments. Another
one that's a big industry in this part of the country, pharmaceuticals. And there, I think you go from the giant ones to the little guys that are, I don't know, either spun out or people that came from a large pharma company started up their own. What's your analysis there?
Well, healthcare has been, there were a number of years where healthcare stock did not do that well, but the past couple of years they've been about the best sector. There's 10 different sectors of the market. Healthcare, technology are two of them. And healthcare has done extremely well. And the larger companies have, the mid-caps have. Some of the smaller ones, some of the spin-offs have done well, and really the biotechs have led the way. So the Amgen and Gilead, companies like that are just cutting edge. I mean, they're like a technology company in a way. And even the big old names like Pfizer have done well again, but they lagged for a number of years because of generic drugs competing. But so we have Abbott and Gilead, as I mentioned, and Hespira, which was a spin-off and is up doing very well. So Biogen. So there are a lot of good opportunities in healthcare.
From more of a macro viewpoint, people have started to talk about possible inflation, the I word again. Any take there? Are you worried? Is the Fed behaving well? Are we impacted by oil ups and downs of the oil prices, energy sector?
Well, having remembered and lived through the hyperinflation of the late 70s, early 80s, when people sometimes say, oh, gee, interest rates were 10%, that was nice, but inflation was 10, 12, or 14, and if you wanted a mortgage, you couldn't get one.
Sure.
So we don't see inflation coming back. I mean, there have been a lot of people out there saying for years now, because of the low rates, that inflation would come charging back, but we don't see inflation, and you want some inflation, that's good for the economy, until the job market gets stronger, and then maybe you start getting some wage inflation, and some of that is good. So we're not overly concerned about inflation at this point, and it's just inflation 2%, something like that. The economy can do very well.
Good. Okay, interesting. How about the massive amount of debt this country has?
And
how's
again,
that going to be paid for?
And the debt also. I mean, we do worry about things. I don't want to say we don't worry about anything, but you grow out of debt. And in the 90s, all of a sudden, the budget was balanced. It wasn't necessarily who might have been in the White House. It was that the economy was doing extremely well. The market was doing very well, so people were paying a lot of capital gains taxes. And more recently, it's been a big number again in debt, and the debt has come down dramatically the past year or so, thanks to capitalism working, more people working and paying taxes, more people making money in the market and paying taxes, and we'll hear more about that from our guest. But again, you can grow out of, the growth sort of brings you out of that debt. So debt along the way has been necessary just to get us out of that terrible period that we had in 2008, and we're still working out of it, and I think the Fed has done a very good job.
Yeah. You sound very encouraging. I'm a banker. I'm a commercial banker. We make loans to businesses, and small business, medium-sized business, not giant businesses. One sector that I've heard some talk about is called the business development corporations, which are alternative lending sources for businesses. Have you followed that industry? Have you looked at it? Supposed to pay a good dividend and that type of thing?
I mean, I'm not sure if you mean REITs, real estate investment trust, things like that pay better dividends. We typically do not invest in them. We're more comfortable, sort of getting the yield or the higher dividends from some of the pharmaceutical companies and some others, but it doesn't mean there aren't opportunities out there. But again, there's a little less volatility in certain companies like a Kraft that might pay a 4% dividend. We're happy with that, and there are a lot of companies that increase their dividends 5-10% a year. So there are opportunities of various types, but we stay more with some of the consumer stocks that are paying good dividends and good quality bonds.
Another issue I've seen recently seems to be more and more people are sort of shying away from, I guess, stock pickers and going to more indexed funds. How do you see that trend working?
The past couple of years have been a little bit rough for hands-on managers who are picking the sectors like healthcare tech and then picking the Gileads of the world, and in some cases have not, or in a number of cases have not outperformed an index fund. Things are starting to change in that regard, and last year most managers did not outperform the index. This year, not too many months into the year, managers are starting to beat the index again, and so stock picking is coming back, and one of the reasons is that the index funds did as well as they did. There were a handful of stocks basically that accounted for most of the gain. And a lot of them were stocks that were sort of coming off their back from 08, 09, that maybe were $5 stocks that went to 20. And a lot of active managers, including us, do not buy stocks typically that are single-digit stocks. So we were missing those, and they accounted for a fair amount of the performance. So I'd say we're happier, and most hands-on managers are happier now, and clients are getting happier that the expertise that you have there is working.
The housing market seems to be making progress and all. Do you have a great degree of confidence that it has gotten through the worst, and that we're going to see better prices have rebounded? I mean, consumer spending is the biggest driver of the economy.
Correct. Yeah, housing is doing better. It is a great driver of the economy. It also is with a great driver and drove it down. And one thing too, if I can just quickly get back to the index funds, in '08 when the market was down 38%, if you were an index fund, you were paying a fee to be down 38%. If you're an active manager, such as us or others, we did a lot better than the market and when it went down. So I think people have to keep that in mind. You know, you want to, over different cycles, and cycles encompass down markets, up markets. So just sort of saying, I'll do whatever the market does, you know, you can do better. But, you know, housing, yeah, I mean, with interest rates as low as they are, housing should be doing even better than it is. Mortgage rates are, I mean, they're basically free.
Yeah, right.
You know more about that than I do.
Unfortunately, I mean, banks make more money when interest rates are higher, not crazy high, but
something
more
moderate,
than a few percent.
maybe like 6, or
exactly.
doesn't have to be 14, doesn't have to be 3 or 4.
Right. Well, besides stocks, there's also bonds, and people talk about asset allocation and that type of strategy. I didn't hear you mentioned bonds in your portfolio.
Yeah, of the $2 billion that we manage for institutions and high net worth individuals, about a quarter of that is in bonds, and we have clients who are totally in bonds. So again, you know, we go with the higher quality investment grade bonds. We might ladder maturities, having something coming due every year, but not necessarily, because sometimes if you look out in the yield curve, I don't want to get too boring on this, you know, there are areas where you can get a better yield than some others. And you don't want to go too long, because one of these days interest rates will go higher again. And you don't want your bonds, as I said before, you know, the best stock in the world can bounce all over. It should go up over a period of time. You don't want your bonds losing value. So you don't want to go stretch on quality and go to lower quality, and you don't want to go out 20 or 30 years and be stuck with a bond when rates go up. So if you have, you know, reasonable maturities, 3, 4, 5 years, rates do go up, you can sell them and buy bonds with higher yields at some point. So we do actively manage bonds, but with the eye on quality and moderate type of maturity range.
Our featured guest, and is coming on in a few minutes to join us, is a tax expert. How much does taxes play into your investment strategies?
Yeah, good question. We have clients who are tax-free. A lot of the institutions, they may be pension plans or endowments, foundations, so we don't have to worry about taxes. Clients who have IRA rollovers, you know, they retire from the 401k, 403b, no taxes there. And then taxable accounts. So you do want to watch short-term gains. If you're getting closer to the long term, you may not want to sell right before that. And again, our guest can tell us more about the interest rate, the percentage, you know, of tax and how that changes. But you want the guiding principle to be the investments, and we will watch the taxes, but tell people, if you're going to pay a tax, the capital gains tax is the best one. It means you were smart and lucky, you made money, and the rate is lower than it would be on income. So making money, you pay some, it's not a bad thing.
Any other advice for our viewers?
I would just say time and patience, and stay away from gimmicks. And as I said, we're very comfortable with individual stocks, you know, versus funds, and you know, the sort of the transparency of that you can see what you own, you know what companies you have, and you know, stay with quality, and you know, don't really, you know, maybe don't listen to that taxi driver.
Right.
Maybe listen to the Uber driver I came over with. That might be better. I don't know.
Very good. Very good. We have a question from one of our viewers today, and I think you're the expert to address it to, Rich. John Abel of Pottstown asks, what are some safe long-term sector investments?
Okay, good question. You know, we mentioned a couple of sectors, technology and healthcare, and they are two of the best, along with consumer. Consumer comes and goes as far as what's called consumer staples like Coke and Pepsi and Procter & Gamble. They're steady. Sometimes they get a little too expensive on a price earnings ratio. And then there's when consumers are starting to feel better, consumer discretionary, such as retail companies or automobile companies. So those are more cyclical. Healthcare and technology are great places to be. You can have 30 to 40% of your portfolio in them, and then into the other sectors also. Again, utilities, you can get some kind of a yield there, but again, consumers good, industrials, if you believe in the growth of this country, and overseas, Raytheon, United Technology, companies like that. So diversify and go with each sector.
I have a follow-up question. When somebody uses the term long-term, I guess what does that mean to you?
How do you define that? True. And I tell people too, because you'll read these things about if somebody's 70 years old, subtract their age from 100, they should have 70% bonds, 30% stock. I think it's the other way around. You tell people too, if you're 70, whether you want to or not, you're going to live to 95, you're a long-term investor. So you don't want to be a long-term stock investor in $3 stocks, but in good quality companies that are increasing their dividends every year, have tremendous productivity, great balance sheets. That's the way to make money over the years.
Sounds a little bit like Warren Buffett.
Yeah, I guess he has some insight.
Very good. If other viewers have a question, we'd be happy to see if we can answer them on the show. Here's how to send your questions to Money Matters.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says Send Us Your Questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
Our featured guest on the show is Nick Yzzi, CPA with Yzzi and Associates. Yzzi is a tax expert, CPA being certified public accountant, so he's very, very well qualified. Nick, welcome to the show.
Nice to be here, Paul and Rich. Some people also think it means cleaning, pressing, and alteration, so we'll see. We'll see how it goes.
Well, if you pay too much in taxes, I guess you do have a feeling of being taken to the cleaners.
Yeah.
Good one.
Good illustration.
We have some questions we'd like to ask you, Nick, about
Sure.
your background, your specialties and all. One of the things that interested me that you mentioned, I'm not saying the whole, phrase correctly, but the Tax Increase Preservation Act or something like that. What is that? Prevention?
The Tax Increase Prevention Act. Well, as has been the tradition lately, which is not a good one, President Obama signed an extenders law, December 19th, 2014, which basically extends a variety of tax provisions that expired December 31st, 13. So what they did was these extenders basically extended what expired a year ago, and it goes retroactive back to January, which gives people a little time to be able to plan. So for instance, one of the good deductions, if I could call it that, would be for someone who's 70 and a half years of age, and they want to contribute money from an IRA into a charity, a direct transfer. As you know, once you have an IRA, there's no way you can not pay tax on it, either you or your beneficiaries. But this is one of those ways where that withdrawal does not produce taxable income. So what's happened is people have already done their planning. They may have done their withdrawals. They may have done their charitable giving outside an IRA, and you pass a law with 10 days to go, and so it minimizes the impact, and it really is irresponsibility on the part of both parties, where they keep bickering and they don't cooperate, and then at the end of the year they decide to initiate legislation that goes back for 11 and a half months, which is ridiculous. So there are quite a few of those. There's conservation easements, which are a tremendous deduction for someone who wants to conserve land. They get a deduction for the fair market value. So there were a variety of things that had true benefit on the business side. I mean, one of the big things was the expense election. It's called Section 179, where you can deduct up to normally $500,000 of business equipment. Well, what had happened, that expired a year ago on December 31st, 13, and they reduced it back to $25,000. But again, December 19th, they're allowing you to spend $500,000 and deduct it.
So let me ask you a question. Again, I'm a commercial banker. I have a new customer. He's a sign manufacturer. We recently financed about a $90,000 piece of equipment for him. So normally he would capitalize that and depreciate it over 5, 7, something like that years. So you're saying that if he handles his taxes correctly or well, he would be able to deduct the $70,000 purchase from his $90,000 purchase from his income?
Yeah, if it's personal property, you can deduct it. I mean, I'll give you an illustration. I had a sanitation client, and they buy $400,000 or $500,000 of container cans and trucks every year, and I had advised them earlier in the year, if you're not able to deduct the $500,000 Section 179 deduction, and you're going to be limited to $25,000, that's probably going to increase your taxes, since they're an S corporation, by about $125,000. And so it becomes a real issue on the planning side in trying to strategize with your clients as far as what they should do, which is this a proper time to buy and invest in capital, and you have the banking considerations, and so it really becomes difficult. So unless we break the stalemate in Washington, I'm not sure what the solution will ever be, because this seems to have become a habit now for the last few years.
And when we deal with smaller companies, frequently we just rely upon tax returns. Business tax returns, personal tax returns. But let's talk about the business tax returns. If they're going to deduct, in the case I just mentioned, let's say $90,000 for this purchase of equipment on their tax return, it's going to show what? I guess a big loss.
Possibly. Yeah, but when you're looking at that, I mean, a banker should be able to look at that and see that that's a statutory item.
Yeah.
And when you look at it from a cash flow basis or a financial statement basis, you could see that if you would take normal depreciation, it would have vastly changed. And besides, you have the tax return treatment. But if you're doing a financial statement that's prepared by a CPA, you don't take that deduction. You would take the normal depreciation. So it wouldn't show up in the financial, but it shows up in a tax return.
Yeah.
And you do have some clients, small businesses, whose banks don't require an audited financial.
That's right.
Or even a review or compilation.
Try to keep the burden low on them.
But it has to be explained, because otherwise it could be distortive.
So what line item would that be called? Purchase of equipment, or?
It shows up on the depreciation schedule. It's called expense, Section 179 expense of assets.
Interesting. Another, I think, Bill, you mentioned had to do with disabilities. Better living.
Yeah, there was, as part of this extenders law too, there was also there was like Division B of the Major Act, and it was something for those who have disabilities, and what they're allowing is something similar to a Section 529 plan that you would use for educational purposes, where you can actually put in $14,000 a year. You don't get a deduction for it, but to the extent you use it for someone who's disabled for housing, transportation, medical bills, then the earnings that generates would not be taxable income. And again, it's not a significant amount, but it can build up over time. And you can have more than one person donate to a disabled person's account.
Now, you do get a deduction for 529 for education, right? If you're
No, you don't.
the donor.
You don't get a deduction for it.
Or a state, or what is that?
Yeah, for Pennsylvania, you can get a deduction for 529, but for federal, the earnings are tax-free, so they build up. So if you put $100,000 in, no deduction, but that could build up over a number of years if you invest it in when your child's young.
You have good stocks, right?
And you could build up $200,000 of earnings, and that $300 that's in there now is fully tax-free, as long as it's used for education.
Right.
What other, mention maybe 2 or 3 other aspects of tax savings or good tax planning for, I guess you can't do too much more tax planning for 2014, the year's over.
Correct.
How about for 15 then, if we're looking ahead?
Well, I mean, one of the for higher level income folks, I mean, you have this issue of the what we call Obamacare or the Affordable Care Act. You had the additional 3.8 net investment income tax. And you can structure, since you guys are in securities and banking, you can structure your investments to try to minimize that additional 3.8% tax, because many times those folks are already in the 39.6% bracket, and then you add another 3.8% on top of it. So, I mean, you can reduce some of your net investment income by sometimes investing in annuities or invest in tax-exempt bonds, or invest in growth stock that won't necessarily produce a dividend versus a dividend type stock.
Right.
You pick that appreciation up at the end. So, in trying to reduce that additional 3.8% tax to minimize that new tax that started in 2013 to help subsidize the Affordable Care Act, which we call Obamacare. So, and then there's always the planning for alternative minimum tax, and which seems to be something that's more of an annoyance.
And that doesn't go away.
It doesn't go away.
It gets worse, right?
It seems to get worse. And it hits a lot of folks in the middle income brackets that it was not intended for.
Right.
So when it started back in the 70s, when I worked for IRS, I mean, it was novel. It impacts so many more people nowadays because of the way it was structured, and because they never factored in the cost of living adjustment for many years, and because of the structure of the tax preference items. So now, they're bringing in $40 or $50 billion from people that were not originally targeted for that.
I guess Congress doesn't want to walk away from that.
You know how that goes.
Right.
So I think it's here to stay.
Yeah.
Last question. There are fewer and fewer married couples these days. In fact, a lot of couples are not getting married. They're dating or whatever it is for 9, 10, 20 years and all. Is there anything in the tax code that coming forward that's going to sort of support that? I mean, usually there is you get a better deal if you're married than not married.
Yeah, well, they tried to eliminate the marriage tax penalty, and they did that because sometimes it's better to file single, which you can't do if you're married. If you're married, you have to either file married joint or married separate. Married separate is the highest tax rates normally. Depends on the structure of the income from each. But that marriage tax penalty that came into effect in the form of the tax brackets never quite stabilized the difference between two singles and a married. So they've not talked about that for a while.
Okay.
There's so many other things that they're working on that sort of went by the wayside.
Sure. Well, it sounds like an awful lot to deal with these days, more and more. I mean, a lot of tax considerations, and the average person really needs, I think, to spend some time with an advisor, not just going on the internet or reading a book or something like that. Situations are very individual, and there's a lot of what I would call esoteric aspects to it and all.
Yeah, it's very complex. And the other thing, the other trend sometimes seems to be where I can buy TurboTax and do my own tax return. And I wouldn't necessarily recommend that, because most times you'll cheat yourself by doing that.
Sure. Well, Nick, thank you very much for joining us. You've been very helpful, very educational, and Rich, real pleasure.
Oh,
so
nice to be here.
To our audience, I'd like to just say, don't forget, here your money matters.